You're watching Mirror 7 News. Stay informed, stay ahead for more news.
If you've been keeping an eye on Dover's stock lately, you've probably noticed it's been a bit of a roller coaster. Over the past week, the share price has dipped by about 3.1%, and since the start of the year, it's fallen roughly 13%. At first glance, that might make some investors nervous. But when you zoom out and look at the bigger picture, Dover's track record tells a very different story. Over the past 3 years, the stock has climbed around 40%, and over 5 years, it's up an impressive 51%. So while short-term fluctuations grab attention, the long-term trend highlights resilience and steady growth. The recent drop in shares seems largely tied to changing market expectations and how investors perceive risks in the broader industrial sector. It appears that some caution has crept into the market's view of Dover. But this raises an intriguing question. Could the stock now be undervalued compared to its true worth? According to Simply Wall-Saints metrics, Dover scores a perfect 6 out of 6 on value checks, meaning it's considered undervalued across every measure they track, a rare feat in today's market. One key method used to assess Dover's value is the discounted cash flow, or DCF, analysis. This approach estimates what a company is really worth by projecting future cash flows and discounting them back to today's value. For Dover, analysts forecast its free cash flow to grow from $555 million currently to around $1.33 billion by 2026, $1.62 billion by 2028, and roughly $2.14 billion by 2035. When discounted to present value, the DCF model suggests Dover's intrinsic share price sits around $220, which is roughly 26.6% higher than the current market price. In other words, Dover's stock is trading at a significant discount to its estimated fair value. The price-to-earnings ratio further reinforces this perspective. Dover's current PE ratio is 20.7x, lower than the machinery industry average of 23.4x, and its peer group's 22.5x. Simply Wall-Saints' proprietary fair ratio, which accounts for company-specific growth, risks, and performance, puts a fair value multiple at 24.6x. This means that, even after factoring in all relevant risks and growth potential, Dover shares are still undervalued relative to what investors might consider fair. In short, while Dover's recent decline may worry some, the underlying fundamentals suggest it could be a hidden opportunity for value-focused investors in 2025. Strong cash flow growth, undervaluation across multiple metrics, and a solid long-term track record all paint a picture of a company whose current share price may not fully reflect its true potential. Stay subscribed for more videos.